Most people think money comes from hard work. You get up in the morning, you go to a job, you put in the hours. At the end of the week or the month, money appears in your bank account. It feels like a simple, honest exchange. You trade your time and your skill for dollars and cents. This is the story we tell ourselves. It is the story our parents told us. It is the bedrock of how we think about our lives, our careers, and our value in the world. We believe that if we just work a little harder, save a little more, we can get ahead. The truth is, the vast majority of money in our modern economy does not come from a government mint stamping coins or printing crisp bills. It is born in a digital ledger with a few keystrokes inside a commercial bank. Money is made before you earn it. This simple fact changes everything. It changes how we should view wealth, debt, and the feeling that we are running in place on an economic treadmill. This is not some fringe conspiracy theory. It is the stated reality acknowledged by central banks around the world, including the Bank of England and the US Federal Reserve. But it is a reality that is rarely discussed in school classrooms or on the nightly news. We are encouraged to balance our personal checkbooks and live within our means, which is sound advice. Yet, the system itself operates on a completely different set of principles. Understanding this difference is not just an academic exercise. It is the key to understanding why things feel the way they do, why prices seem to rise faster than your paycheck, and why some people seem to get rich without ever breaking a sweat. The journey to understanding how money really works begins with letting go of the simple story we were taught. It requires us to look behind the curtain of our own bank accounts. We need to question the very nature of the numbers we see on the screen. Where did they come from? Who put them there? Here is the simple, powerful truth that changes everything. Commercial banks, the ones on your local high street, create most of the money we use every day. They do not get it from the government. They do not get it from the mint. They create it themselves. Every single time, they approve a loan. This is the core engine of our monetary system. It is not a sideshow. It is the main event. When a bank makes a loan, it literally creates new money out of nothing. It feels like magic. But it is just modern accounting. Let's walk through a concrete example. Imagine a small business owner, Sarah, wants to expand her bakery. She needs a $100,000 loan to buy new ovens. She goes to her bank and presents her business plan. The bank reviews her application, checks her credit, decides she is a good risk. They approve the loan. At that moment, something incredible happens. The bank does not go into a vault and pull out $100,000 of other people's savings. Instead, the loan officer types a few numbers into a computer. Suddenly, Sarah's checking account balance reads $100,000. That $100,000 is brand new money. It did not exist a moment before. It was not transferred from any other account. The bank created it with a keystroke. Sarah uses the digital money to pay the oven manufacturer. The manufacturer deposits it in their bank. The new money begins to circulate, moving from one account to another. The bank now holds a new asset, Sarah's promise to repay $100,000 plus interest. The loan created a deposit. This is the fundamental, often misunderstood nature of banking. This repeats millions of times a day around the globe. Every car loan, every mortgage, every business credit line, every credit card swipe creates new money in the exact same way. The bank creates a loan, which simultaneously creates a matching deposit in the borrower's account. The money supply isn't set mainly by government printing, it's set by how much commercial banks lend. If banks lend aggressively, the money supply expands. If they lend less, it contracts. They are the true creators of our money. The most persistent myth in banking is the idea that your deposits fund loans. We imagine a banker taking our saved cash and handing it over to a borrower. This is simply not how it works. The reality is the complete opposite. Loans create deposits. When a bank issues a mortgage for $500,000, it creates a new $500,000 deposit in the home seller's account. The bank did not need to check if it had enough savers money on hand to make the loan. It created the money on the spot, backed by the borrower's promise to repay. Deposits are important, but for a different reason. After a bank has created a loan, the new money starts moving around the system. Banks settle payments with each other at the end of each day. To do this, they use a special kind of money called reserves, which they hold at the central bank. Your deposits provide a stable, low-cost source of funding for the bank to manage these interbank payments and to meet its reserve requirements. They are a consequence of lending, not a prerequisite for it. If commercial banks create most of the money, what does the central bank actually do, like the US Federal Reserve or the European Central Bank? While it is true that central banks have the exclusive right to print physical cash, notes, coins, this form of money makes up a tiny fraction. often less than 5% of the total money supply in a modern economy. The vast majority is the digital money created by commercial banks. The central bank's primary role is not to be the main creator of money, but to be the manager and regulator of the system where money is created. Think of the central bank as the referee in a high-stakes basketball game. The commercial banks are the players, constantly trying to score points, make profitable loans. The central bank does not play the game or score points itself. Instead, it sets the rules. Its most powerful tool is setting the main interest rate. By raising this rate, it influences the cost for commercial banks to borrow from each other. By lowering this rate, it influences the cost for commercial banks to borrow from each other. This, in turn, affects the interest rates that banks charge their customers for mortgages and business loans, making borrowing either more or less attractive. Commercial banks hold accounts at the central bank, filled with special money called reserves. Banks settle payments using their reserve accounts. The central bank can increase reserves in the system or decrease reserves in the system, a process known as quantitative easing or quantitative tightening. So, the central bank's power is immense, but it is indirect. It guides and nudges the system. It tries to steer the economy away from the cliffs of high inflation or deep recession by making it more or less profitable for commercial banks to create money through lending. To make this abstract idea stick, let's imagine a simple board game. In this game, there are 100 players living in a small village. The goal is to build houses, grow food, and accumulate wealth. However, the game starts with 0 points. No one has any money. The only way for points to enter the game is through the banker. Instead, the banker has a rulebook and a ledger. Let's say player 1 wants to build a house, which costs 100 points. The banker simply writes plus 100 points next to player 1's name in the ledger. Voila, 100 new points have just been created in the game. Player 1 can now spend these points, paying player 2 for wood and player 3 for labor. The game's total score, its money supply, is now 100 points. The banker's ledger shows that player 1 owes 100 points. Player 10 sees player 1's new house and wants one too. Maybe the price of a house is now 120 points. Player 10 has to go to the banker and borrow 120 points. The total money supply jumps to 220 points. The players who got the first loan, and those who received the first wave of spending, had a huge advantage. First, new money, points, only enters the economy when someone goes into debt. Second, this new money creation can cause prices to rise, inflation. Third, the players who get access to the new money first have a distinct advantage. This system of money creation is not just a theoretical concept, it has profound effects on your daily life. The most direct impact is on the prices of the things you buy. When banks are lending freely, they pump new money into the economy. Businesses and consumers, flush with borrowed cash, start spending more. Increased demand for goods and services allows sellers to raise prices. Cars, houses, coffee, lumber. There is more money chasing the same amount of stuff. Inflation shows up at the grocery store and the gas pump. Prices often rise much faster than your salary. Wages and salaries tend to be sticky. Annual contracts, slow negotiations, company-wide pay scales, they do not adjust instantly. However, the prices of goods, commodities, assets can change in an instant. A flood of new money via bank lending lets prices surge quickly, while wages lag behind. You feel like you're working harder but falling further behind. Your paycheck might be bigger in numbers, but its purchasing power, what it actually buys, has decreased. The way money is created systematically benefits those who own assets over those who earn wages. This is one of the most significant consequences of the system, a powerful engine of wealth inequality. An asset is anything that has value and can produce income or be sold for a profit, such as real estate, stocks, bonds, a business. A wage, on the other hand, is a payment for your time and labor. When banks create new money and lend it into the economy, much of that money flows directly into asset purchases. A mortgage creates new money to buy a house, pushing up property prices. A corporate loan might be used to buy back company stock, boosting its share price. Wealthy individuals can borrow against existing assets to buy even more assets. This creates a powerful feedback loop. New money creation inflates asset values, and owners see their net worth grow, often without doing any additional work. Wage earners are on the other side of this transaction. They receive it secondhand, after it has already pushed up prices. Their wages rise much more slowly than asset prices. The tenant faces rent increases that outpace salary growth. We are often told that money is scarce. Money itself is not scarce. In our modern system, money is anything but scarce. Commercial banks can create it. The total volume of money in the system is elastic. The real problem is the scarcity of access to new money. Most money today is created by private commercial banks when they make loans. It is not created by governments or funded by savers. Loans create deposits. New money is born as debt. This simple fact is the hidden operating system of our economy. It dictates who gets ahead and who falls behind. It drives inflation, fuels asset bubbles, and contributes to the growing chasm between the rich and the rest. Remember the game analogy. New points only enter the game when a player borrows them from the banker. The players who borrow first, or who are the first to receive the newly created points in payment, get a massive head start. They are playing the same game, but they are playing on a board that has been tilted against them from the start. Understanding this system is not a magic bullet that will solve all your financial problems, but it is the essential first step. It allows you to stop blaming yourself for systemic issues. You can understand why owning assets that appreciate with inflation has historically been a better strategy for building wealth than just saving cash. You can watch the actions of central banks and governments with a more critical eye, knowing how their policies will affect money creation. Money is not scarce. Access is. If this explanation helped you see money differently, subscribe. Every video here is designed to help you understand money and business clearly, without hype.